Do you want to achieve financial independence even faster? Then what you need is what's known as FlexFi. That is flexible financial independence. In this video, we are going to talk about what flexible financial independence is and how you can achieve it. First, let's start with defining what FlexFi is. So of course, defining it is going to depend on who you ask. This is just kind of a made-up thing when it comes to financial independence. But generally speaking, FlexFi is usually 20 times your annual expenses. So if you have investments that are worth 20 times your annual expenses, that would represent a 5% safe withdrawal rate. If you know anything about what financial independence is, then you are FlexFi. So instead of having the traditional 25 times your annual expenses with a 4% safe withdrawal rate, you would have a 20 times your annual expenses in investments and a 5% withdrawal rate. And if you do this, instead of the 4% safe withdrawal rule, according to the original Trinity study, you actually have a 83% chance of success in 30 years. So if you were to withdraw 5% of your portfolio per year for 30 years, according to the original Trinity study, you would have an 83% chance of success of never running out of money within a 30-year period. And you would have a median terminal value of $6.8 million in your portfolio after 30 years if you were to have started with a $1 million portfolio. So after 30 years with a 5% safe withdrawal rule, the median terminal value, which means your ending portfolio value, most likely is going to be somewhere near $6.8 million if you started with $1 million. Now, of course, that $6.8 million isn't going to be as powerful when it comes to purchasing power as it is 30 years from now because of inflation, but it's still $6.8 million. It still actually grew on average, even though you withdrew 5% of your portfolio. And the great thing about flexible financial independence is that you're not actually looking to, completely stop earning money forever. You are just using it as a tool in order to, pursue other things in your life, whether that be to travel, whether that be to spend more time with family, whether that be to pursue a business on the side, maybe an easier startup business, whatever it may be. Flexible financial independence can offer that for you at a much faster rate than traditional financial independence because you need less money in investments in order to become FlexFi. You only need 20 times your annual expenses. Just as with traditional financial independence, there are 3 different things that you can do in order to achieve FlexFi much faster. So the first one is that you can adjust your spending downward. That is, you can cut your expenses in order to increase the amount of money that you can put towards your investments. The second one is that you can increase your income to where you have more income to put towards your investments, or you can do some combination of both, where you decrease your expenses and you increase your income. The most important part of decreasing your expenses is that you focus on decreasing your fixed expenses or your monthly reoccurring bills, because the less fixed expenses you have, the more flexibility you have, and that is a big part of FlexFi. On the other hand, when it comes to increasing your income, you can develop what's known as a side hustle. And that just means where you can flexibly work, most likely on your own schedule, on your own pace, whatever it may be, in order to earn a little bit of extra income on the side. Maybe even to, supplement your 5% withdrawals or to decrease them down to 4%. And when you're going for FlexFi and you begin to actually withdraw from your portfolio, you want to utilize what's known as the 95% rule. And generally explain just really quickly what that means is that when you have volatility in your portfolio, in your investment portfolio, your investments can go down in value temporarily, they can go up in value temporarily. But when they go down, you want to withdraw a little bit less than what you were originally withdrawing. So according to the traditional Trinity study, you would withdraw 4% of your starting value of your portfolio and you wouldn't adjust downwards. You would actually adjust upwards for inflation. But when it comes to the 95% rule, you're going to be a little bit more flexible in your withdrawals. So that means you have to have a little bit of buffer built into how much you spend every single month. And that's why you want to keep fixed expenses down, and so that you can put your variable expenses, you can have those a little bit higher, but they can also adjust down. That could be things like travel and entertainment, dining out, whatever that may be, but those can be variable. You can adjust those downwards at any time. You're not locked in, you're not fixed on those expenses. The 95% rule says that you can adjust your withdrawals down, 95% of what they were, the previous withdrawal. So for example, if you have a $1,000 withdrawal, you can adjust that down to 95% of that, which should be $950. and then you can apply that to, whatever your actual withdrawals are. So if the value of your portfolio, temporarily goes down by 10%, you're going to be withdrawing 5% less than what you did before. And if you follow the 95% rule, it's talked in a lot more detail in like a few books and a lot more articles on the internet. But if you follow the 95% rule, it's going to greatly help increase your chances of never running out of money in a very long period of time. Even though you already have an 83% chance, at least according to the original Trinity study, of never running out of money if you never adjusted your spending down and you actually increased it for inflation. Utilizing that 95% rule just increases your odds even further. But before I move on, I just want to say, if you are liking this video so far, please don't forget to like it, give it a thumbs up. It really helps me out and I really do appreciate that. And at the same time, consider subscribing to the channel and putting on that bell for notifications, because every single week I am putting out new information on personal finance, on financial independence, on becoming a master of your own cash flow. And I just know that there's something that I can help you with. Now, getting back to FlexFi, let's talk about your priorities. If you want to become flexibly financially independent, then here are some priorities that you should probably have. So the first priority is that you should probably be debt-free, because if you have no debt, then that eliminates your fixed expenses right then and there, because debt is usually a fixed expense. You usually pretty much have to pay off of your debt, or there could be a lot more devastating consequences. So having no debt at all when you become flexibly financially independent is probably best. Second is that you actually want to have a emergency fund already built into your FlexFi plan, because even though you are flexible with your spending, there could be a negative event that causes you to have to spend a lot more money in any given point in time. That would be known as an emergency that requires a larger amount of funds. And if you have that emergency fund already ready to go, then you should be covered, and then you can just slowly replace that emergency fund later on down the line, and then wait again for the next emergency, but hopefully it doesn't come too soon. And third, another big priority in your FlexFi is having a larger amount of discretionary spending. Because if you have more discretionary spending, that is like optional spending, ones that can be variable and that can adjust easily month to month, that is what's going to allow you to become FlexFi, because you can adjust that discretionary spending down when the value of your portfolio is temporarily down, due to just overall general activity within the markets. If you follow those three priorities, then you will be well on your way to becoming flexibly financially independent. As I mentioned before, a big part of being FlexFi is being able to adjust your spending. And being flexible is, the name of the game in FlexFi. And so one way that you can be flexible is that you can utilize what's known as geographic arbitrage. So geographic arbitrage is actually moving places like to a lower cost of living area, maybe even temporarily while your investments are down, maybe just to have more money so that you can spend, your more fun money, whatever it may be. Utilizing geographic arbitrage and moving somewhere where the cost of living is cheaper can really help you become financially independent. If you're moving from, let's say we're using the United States index, 100 is the average cost of living in a particular city in the United States. If you move from a city that has a living index of 120 to a city that has a living index of 80, then theoretically you just cut your living expenses by 40%. Now, it might not be that linear, but you can bet that you're going to have lower expenses in that area that is rated as an 80 as opposed to one that's rated as a 120. And you can just do this not just within your own country, but you can do this abroad as well. Moving from the United States to a very low cost of living country can save you a ton of money and help you become flexibly financially independent very, very quickly. The next way that you can adjust your spending is to temporarily stop travel. So if you like to travel a lot and you are flexibly financially independent, but let's say the overall general market is down and your investment portfolio is down a little bit, then you can just cease traveling at that time, just for temporarily, until the market recovers, because travel is actually kind of expensive. It actually does cost a bit of money in order to travel from point A to point B. You have a lot of other expenses that are associated with travel that are different from where if you were just staying in one place. So you can temporarily limit travel if your portfolio is down, and that will help you adjust your spending downwards temporarily. And my third tip for adjusting your spending downward to be FlexFi is to just temporarily stop saving for your expensive items. So if you generally would save money, for a larger purchase, let's say you're saving money to purchase a $2,000 laptop like I recently did, then you can just temporarily stop saving for that money. And so that means you need less cash flow this month. If your portfolio is temporarily down, you can halt your savings. Maybe if you're saving for a new vehicle, you can just temporarily stop saving for that until the market recovers. Whatever it may be, just you can temporarily stop saving for larger purchase items and maybe extend the dates a little bit to when you're planning on purchasing those items if the overall general market is down and you're withdrawing from your portfolio. So that's an easy way to just withdraw less from your portfolio when the value of it is temporarily depressed. On the other side of it, we have ways to increase your income while you are flexibly financially independent. And of course, you can start a business, become self-employed, earn some money that way. You can get a part-time job, just work 20 hours a week, whatever it may be, in order to supplement your withdrawals or to decrease your actual percentage of your withdrawals from your portfolio if you want to do that. Or you can consider something like seasonal employment, where you only work for a certain season, a certain time out of the year. Maybe you work during tax time as a tax preparer, or maybe you work in the summer as a coach for some kind of sports team, or maybe you work during the holidays for the holiday rush in shopping for like Thanksgiving and Christmas and things like that. Whatever it may be, those are 3 options that you can do in order to increase your income if you want to pursue flexible financial independence. And so as you can see here, FlexFi isn't that much different than traditional financial independence. But what I want to leave you with is, why would you choose FlexFi over regular financial independence? Why FlexFi? Well, I think the number one reason that I want to give you for why maybe FlexFi is best for you rather than just traditional financial independence is that you can gain your freedom much quicker. You can gain back control of your own time much faster than you can for traditional financial independence. Getting investments that are worth 20 times your annual expenses, it happens a lot quicker than 25 times your annual expenses. While at the same time, you're probably going to pursue other things that make you money, even if it's just a little bit, or you're going to decrease your expenses, by utilizing geographic arbitrage, whatever it may be. FlexFi allows you to gain control much faster, even if your plan fails. Look at what your worst case scenario is. This is one of my favorite quotes in financial independence. Your worst case scenario is everyone else's everyday scenario. You have to go back to work and you have to work for a living. That is your worst case scenario. So what are you waiting for? Take back your freedom and achieve financial independence. Whether that be FlexFi or regular financial independence, you need to watch this one video that I made called How to Achieve Financial Independence in 10 Years. I'll put it right here for you. If you haven't already, that video will give you the outline to how to achieve financial independence, and that can be applied to FlexFi as well. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.